Jeremy Grantham, a well-known investor who predicted past market crashes, is warning us about what he calls a super bubble. What does this mean for us? Why are stocks, bonds, real estate, and cryptocurrencies all so overpriced right now? How did we end up with such high prices everywhere? Grantham's concerned that these inflated prices could lead to a big financial crisis. Why are stocks and bonds so expensive? With all these bubbles getting bigger, what could make them burst, and what should we watch for? Grantham's warnings are based on previous financial crashes, so could we be facing another one soon? Well, to know all about this, you have to stay tuned till the end. The global economy is at a tipping point, according to Jeremy Grantham, a renowned investor and co-founder of the asset management firm GMO. Grantham has earned a reputation for his ability to predict major market crashes, having accurately forecasted the dot-com bubble burst in 2000 and the housing bubble collapse in 2008. Now he warns of another impending crisis, one that could have far-reaching consequences for economies worldwide. Grantham describes the current situation as a super bubble, a term he uses to highlight the unprecedented levels of asset overvaluation across various markets. A super bubble refers to a situation where multiple asset classes, stocks, bonds, real estate, are all significantly overpriced. Grantham believes that the current super bubble, which he views as the fourth in the last 100 years, is largely driven by excessive monetary stimulus, low interest rates, and a surge in speculative behavior among investors. Grantham's concerns about the current super bubble are deeply rooted in the extraordinary levels of overvaluation seen across various financial markets. To grasp the full scope of the problem, we must delve into some crucial figures that highlight just how inflated these markets have become. The U.S. stock market has witnessed an impressive bull run over the past decade. From its low in 2009, the S&P 500 index surged more than 400% to its peak in 2021. However, as of 2024, the S&P 500 is trading at a cyclically adjusted price-to-earnings ratio of over 35. This is significantly higher than its long-term average of around 16. The CAPE ratio, which adjusts for inflation and smooths out earnings over a decade, is a critical indicator of market valuation. Historically, a CAPE ratio above 30 has often preceded periods of poor returns or market crashes. The current elevated level suggests that the market might be due for a significant correction, as such overvaluation has historically been unsustainable. The bond market, especially in the US and Europe, has also reached unprecedented levels. By 2023, the global bond market was valued at approximately $133 trillion. During 2020, the amount of negative yielding debt peaked at $18 trillion, reflecting a situation where investors were willing to pay for the safety of holding government bonds rather than seeking returns. The yield on U.S. 10-year Treasury bonds has been historically low, frequently falling below 1% for extended periods. These low yields indicate that investors are accepting minimal returns for perceived safety, which is not a sustainable long-term scenario. Such extreme conditions in the bond market often signal overvaluation and a potential future adjustment. The real estate sector has not been immune to these inflationary pressures. In the United States, home prices have skyrocketed by over 40% since 2019, with the median price of home surpassing $400,000 as of 2024. This sharp increase is largely driven by persistently low interest rates and a supply of shortage in the housing market. The result has been a surge in housing costs, raising concerns about affordability and the risk of a market correction. The rapid appreciation in home prices echoes the characteristics of other asset bubbles where prices rise far beyond fundamental values. The rise of cryptocurrencies, particularly Bitcoin, has added another layer to the speculative frenzy. Bitcoin's price, for instance, surged from approximately $7,000 in early 2020 to over $60,000 by the end of 2021, a staggering nearly 800% increase. Although the cryptocurrency market has experienced fluctuations, the overall trend highlights a high level of speculative activity. The total market cap of cryptocurrencies reached nearly $3 trillion at its peak in late 2021, further emphasizing the extent of the speculative bubble in digital assets. These figures collectively illustrate the significant overvaluation present in today's financial markets. Grantham's warning about the current super bubble is grounded in historical precedent. High levels of overvaluation often lead to significant market corrections. The inflated asset prices across stocks, bonds, real estate, and cryptocurrencies suggest that the market conditions are ripe for a potential downturn. Central banks have played a pivotal role in inflating the super bubble. Following the 2008 financial crisis, central banks globally implemented aggressive monetary policies to stimulate economic growth. These measures included lowering interest rates to near zero levels and engaging in large-scale asset purchases known as quantitative easing. Between 2008 and 2022, the Federal Reserve's balance sheet expanded dramatically from under $1 trillion to nearly $9 trillion. This expansion was primarily due to the Fed's purchases of government bonds and mortgage-backed securities. These actions injected vast amounts of liquidity into the financial system, encouraging investors to seek higher returns in riskier assets such as stocks and corporate bonds. The extended period of low interest rates, beginning after the 2008 crisis and continuing through the COVID-19 pandemic, has significantly contributed to asset price inflation. The cheap borrowing costs have made it easier for individuals and corporations to take on debt, fueling investments across various asset classes, including real estate and stocks. Grantham also highlights the moral hazard created by the central bank policies. By consistently intervening to support financial markets during downturns, central banks have fostered a mindset among investors that any potential losses will be mitigated by future interventions. This Fed put has encouraged risk-taking behavior, as investors believe that the central bank will step in to prevent significant market declines. And this expectation has fueled the speculative behavior seen in various asset markets, contributing to the creation of the current bubble. Debt levels represent a critical risk highlighted by Grantham, who views them as a potential time bomb for the global economy. As of 2024, global debt has soared to an alarming $300 trillion, which is approximately 350% of global GDP. This figure has surged from $188 trillion in 2010, reflecting the rapid accumulation of debt over the past decade. Additionally, corporate debt in the United States has surpassed $11 trillion, with a substantial portion rated as junk or near junk status. In the U.S., total household debt reached $16 trillion in 2024, with mortgages making up the largest share. While low interest rates have made borrowing cheaper, they have also driven up home prices, heightening concerns about housing affordability and the potential for a market correction. Investor psychology plays a crucial role in the formation of bubbles, a factor Grantham underscores as a significant driver of market extremes. This behavior was evident during the dot-com bubble of the late 1990s, when investors flocked to technology stocks without regard for their profitability or valuation. A similar pattern has emerged recently with crypto and meme stocks. Fear of missing out, or FOMO, is another powerful psychological force driving bubbles. During a bubble, this can foster a belief that this time's different, leading to a perception that traditional valuation rules do not apply and prices can keep rising indefinitely. This mindset was prevalent during the housing bubble of the mid-2000s, when many thought home prices would never fall nationally. Grantham's warnings about the current super bubble are rooted in historical precedents of market bubbles that ended in disaster. Examining these past events provides insight into the potential consequences of the current situation. For example, the dot-com bubble of 1997 to 2000 saw investors heavily investing in technology stocks, many of which had little revenue, leading to the NASDAQ index to surge to over 400%. However, when that bubble burst in March 2000, the NASDAQ plummeted nearly 80% in 2 years, erasing trillions in market value and triggering a severe recession in the tech sector. So what are your views on today's video? Let us know in the comments section below. And for more amazing videos, make sure you subscribe to our channel.